Welcome back to this week's Mindset Minutes episode. I'm your host, Stephen Pesavento, and each week we share mindset tips and investing strategies to help you take your business and investing career to the next level. And today we're going to be diving into a topic that I absolutely love and adore, and it's really about the concept of getting clear on what you want and why you want it, and why it's so important as a passive investor to spend some time up front getting clear on that what and the purpose behind why you're investing so you can really make those smart investment decisions. So stick with us. We're going to dive into some great stuff. You're going to absolutely love it. So let's get right to it. This is the Investor Mindset Podcast. And if you're just joining us, please hit that subscribe button down below and make sure you never miss another episode. If you've been listening for any amount of time, we would love those reviews. They help us reach even more people. It's one of the number one reasons we're able to get such great guests on this show. So pay it forward to someone else by sharing this with them or dropping a review, and we'll get right into this episode. The importance of getting clear on what you want and why you want it is such a key component of success, regardless if you're an entrepreneur or an investor. And doesn't matter what part of the business you're in, doesn't matter whether you're passive or active. At the end of the day, you need to know what you want and why you want it. But it's especially important if you're a passive investor. It's especially important if you're making decisions upfront on who you're going to invest with, and therefore handing over the responsibilities of those activities to that key sponsor, that partnership team that you're going to work with. And at Von Finch Capital, my investment firm, what I've found is that through talking with investors, so many people are interested in investing. They're looking to create wealth and income, but they're not exactly clear on what they're looking for. And so this is why it's so critical, because when you get clear on what you want and why you want it, it allows you to be able to start identifying and noticing when you see those opportunities come down the pipeline. It's critical because in this market right now, it's very competitive to be able to find deals. And therefore, when sponsors are bringing great deals, they're filling up within a matter of days and weeks. And it's important as a passive investor that you're being able to sit in the position of knowledge, understanding, are you looking for cash flow, equity growth, or maybe a blend of the two? Understanding your timeline. How long are you looking to hold on to that specific investment? And then, of course, what is your overall risk profile? Are you someone who's looking really to be able to hedge against inflation and aren't really interested in making a huge return, but want to make sure that it's heavily protected? Are you someone who's maybe more in the middle? You're looking for great returns, but you're also looking to be in the most safe and secure position? Or are you somebody who is searching for the highest rate of return that you possibly can in relation to that risk profile? So we're always looking at things from a risk to reward perspective. It's called asymmetric risk to reward. That means you're getting a lot more return in comparison with the amount of risk that you're taking. So we'll talk more about that in just a second. But it's critical to understand whether you're someone who's looking for cash flow or for overall equity growth, because when you're seeing these deals come through, typically they move pretty quick. And there's a big difference. If you're someone who's looking to live off that income, this is going to replace your current income, or it's going to create a dividend that's going to be able to give you a little bit more flexibility and freedom in your career. And you believe that living off that money or having it coming in on a consistent basis is going to be right for you, or you feel more safe and secure because you have some kind of payment, some kind of dividend coming in, then going the cash flow route is going to be really important. And now there's, of course, deals that only cash flow and don't really have much back end. It's just kind of stable the whole way. And there's deals that have some cash flow and then have that nice back end. We call those cash flow growth plays or a hybrid. And it gives you a little bit of both. But if you're someone who is not in a position where you're looking to live off the income and you don't necessarily feel more safe and secure because you have some payments coming in, that's not as important to you, then focusing first on what the overall rate of return is going to be important for you as an investor. The reason for that is because there's different types of opportunities, some that require either more work or do not pay a dividend during the hold of the project, or maybe don't pay a dividend for 1 year out of the 4 or 5 year hold, or 1 year out of the 3 year hold. Those kind of opportunities typically will have a larger back end, a larger overall rate of return. And the difference that we're seeing, and it's not it's not like a clear across the board that this is the definitive difference. But what we're noticing is that we're often seeing cash flow deals that are creating, a 6 to 8% return. And then overall, they're able to create, a 14 to a 17% overall annualized return, or IRR, very similar across those deals on that perspective. Now, of course, there's deals that are much higher than that, and there are deals that are much more conservative that are lower than that. However, on the other side of the coin, when you're looking at these equity plays, these equity growth scenarios, they're really great for hedging against inflation because you're really adding a lot of value to the asset. Maybe you're purchasing something for $5 million, you're putting in $500,000, and then you're going to sell it for $7.5 million or $8 million. You can see that you're creating a pretty big delta, pretty big growth of the equity in that position. Now, what's great about that is when you sell that property, you as the investor reap the reward, and that goes directly back into your pocket, and you're able to go then invest again, either into another equity play or another cash flow play. Now, of course, we always are looking for cash flow, we're always looking for deals that produce income during the hold, but oftentimes it is a trade-off between the two. Which one is most important? And the strategy that you end up going with is going to help you get more of whatever that piece that's most important to you. So that's number one, cash flow, equity, or are you looking for a blended of two? We call that a hybrid. Or the next thing you need to know is your timeline. Are you someone who is looking to turn over your money, grow it as quickly as possible? Maybe shorter timelines might be most effective for that. You're going to then need to find another opportunity or work with that operator in the next opportunity. Or are you someone who's looking to set it and forget it, place that money, not have access to it, be able to reap the rewards off of that investment in, say, 5 to 7 years, or potentially longer if you're looking for a longer term? Then when it comes to the risk profile, that's going to come down to what feels best to you. As a very young person, often they are more comfortable with a little bit more risk. They're more comfortable because they have a longer timeline in order to recoup any of those losses that may happen. With somebody who is a little bit older or maybe in a little bit more of a conservative position, you're going to look for something that might be a little bit more conservative. So the return profile does not always dictate that it's more conservative or more risky. However, it can sometimes be an indicator, and it's great to ask your sponsor exactly how this deal fits into the risk profile. Is it very low risk? Is it medium? Is it something that has a higher risk? Or is it somewhere kind of in between those? So very, very important. So coming back, once we understand what we're investing for and why we're investing for it, it makes it easy for us to make that decision of what it is that we're actually looking for. So it's such a great reminder to just sit down, reflect. What do I really want? Am I looking to spend more time with my family? Therefore, I'm looking to replace my income. Am I looking just to know that my portfolio is growing? So in 5, 10, 15, 20 years, I'm going to be able to retire and then move into some type of dividend paying structure? Am I somebody who is just simply looking to grow it as quickly as I can because I'm making so much money elsewhere that I would just love to see that growth? Or maybe am I investing for the purpose of just holding on to the wealth? Maybe you're somebody who has so much income coming in that you're really just looking for a place to park it to hedge against inflation as we're seeing asset prices go up. And we all know that real estate's a great hedge against inflation. So let me know down in the comments or let me know in the DMs on social. You can find me at Steven.Pesavento on any social media. Let me know, what are you looking for when it comes to investment? Are you someone who's looking for cash flow? You're looking for equity growth? Or are you looking for a blend of the two? Would love to hear from you. And of course, you guys, your situation and our situation individually when it comes to these investing goals will change over time. As we get more access to capital, we're looking to diversify. As we come out of one investment and we're looking to rebalance our portfolio, we'll change our investment goals every 6 to 12 months. And so it's important to kind of come back, reflect on this from this position, and then move forward with that decision from there. So as always, I encourage you guys, if you're interested in investing in the same type of multifamily opportunities that I personally invest in, head over to vonfinchcapital.com/invest, and you can learn a little bit more about exactly the type of deals that we're doing, and you can apply to work with us and become a part of our investor club and our investor network. So With that, I thank you guys so much for joining us. I encourage you to go out and apply this strategy and get clear so that you can start making these investments. And even more so, ask yourself, what did I learn from this and how can I apply it today? Thanks so much, you guys, and we'll see you next time. If you're ready to start leveraging the power of partnership in your portfolio, then I invite you to invest directly alongside us in the same type of institutional investments that I personally invest in. These are located in some of the strongest markets across the country, operated by managers with decades of experience, and we come together to leverage the power of partnership to be able to deliver phenomenal returns. You can learn more and apply to work directly with us at vonfinch.com/invest. Be able to schedule a time directly with a member of our team and see if this is the right fit for you and your portfolio. That's vonfinch.com/invest. I look forward to speaking with you soon. Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.